So as Luca said, we're going to do this presentation in two parts. My side, as most of you know, I'm Cristina Costa. I'm in charge of covered bond and SSA research at Barclays, and then I'm also a member of the ECBC steering committee. So my presentation today, I just wanted to touch upon the basics. So look at the definitions of the various maturity structures, what the differences are, who the main issuers are, look at volumes and how the market has evolved over the years, look at possible spread differentiations, and then give you a little bit of a historical tour of how the market has developed. And then I'll hand over to Jane, who will give a perspective from a rating agency point of view. So I'm trying to make this, as Luca said, boring topic a little bit more interesting. But just to start off, for those of you who are not so familiar, let's start off with some of the basics with the definitions. So when we talk about a maturity structure in covered bonds, we have three main types. The traditional type is the hard bullet covered bonds. And this is where payments have to be made when due according to the original schedule date. So for example, if today I were an issuer and I issued a 5-year covered bond with maturity 15 May 29, then failure to pay in full at this scheduled maturity date would result in a default of the covered bonds, and the covered bonds would accelerate. The next type is what is denominated as soft bullet covered bonds. These covered bonds have often predefined, transparent criteria defined. Now, prior to the European Covered Bond Directive, these objective criteria were defined in the covered bond prospectuses. Usually in soft bullet covered bonds, the maturity date, so if it's a 5-year, can be extended by typically up to 12 months. But again, it has to be by objective defined criteria. And usually these criteria are either lack of liquidity, failure to pay, or issuer bankruptcy. So basically a soft bullet covered bond acts as a hard bullet covered bond as long as everything goes well. So payments have to be made due according to the original schedule. But contrary to the hard bullet covered bonds, failure to pay on the scheduled maturity date does not trigger a default of the covered bonds. Instead, the covered bonds can be extended by, for example, up to 12 months. And during this extension period, covered bonds can be redeemed using the covered bond proceeds. Now, acceleration of covered bonds only happens when there is a failure to pay on the final maturity date, i.e. the additional extended maturity date. And now the third type of covered bond structure is the conditional pass-through covered bonds. Now this was introduced by Dutch issuers, first NIBC and then other issuers introduced it, but we've also had conditional pass-through covered bonds in Austria, Italy, we've had in Portugal, we've had in Australia. So it has grown, but still a niche program, and as I will show later, some of these issuers have gone back to soft bullet. Now this in this type of extendable maturity structure, again, like a soft bullet, failure to pay by the scheduled maturity date does not trigger default of the covered bond, but leads to the extension of the maturity date. But contrary to the soft bullet, which is up to 12 months, in this case, the extended maturity date is linked to the maximum legal maturity of the underlying assets. So for example, say that you have a covered bond where the longest dated mortgage loan in the pool is 30 years, then in theory, the covered bond could be extended by up to 30 years. And during this extension period, efforts will be made maybe every 6 months to try and sell parts of the assets in order to repay the investors. Now, here you just have an overview table, but what I wanted to point out is that, as Jane will highlight more in her presentation, From a rating agency point of view, these extendable maturity formats are perceived by rating agencies as having a lower refinancing risk because there is a higher probability that investors will be paid in full in times of crisis. And for this, for instance, then rating agencies will sometimes demand the issuer hold lower OC levels, and sometimes they have additional rating benefits. And so that's why we've seen some issuers adopt these CPT covered bond formats. Now, as I was saying earlier on these, in terms of these objective defined triggers, up till recently, these triggers and language on the extendable maturities were only included in the prospectus. But with the enactment of the EU Covered Bond Directive, we had an introduction of European-wide legislation, and in particular the need to harmonize the various extension options that many covered bonds programs had contractually introduced. And so in Article 17 of the Covered Bond Directive, we have the requirement that issuers need to be to be able to issue covered bonds. And this says that member states have to include objective triggers, and these are specified in national law and not at the discretion of the issuer. And this, I think this is something that regulators and some investors were concerned that when they buy a covered bond with an extendable maturity, that the issuer can just decide on a whim to extend. But no, instead, there have to be really objective triggers of when they are allowed to extend. Now, this is just showing what I said earlier about some of the pros and cons of conditional pass-through covered bonds. In terms of collateral efficiency for the issuers, less need for ALM matching, higher covered bond rating and less dependency on the issuer rating level. So this is why some covered bond issuers from Portugal, from Italy back in the day decided to set up covered bonds in CPT format, because then they were able to get a rating uplift on the covered bonds. But from the investor point of view, the more complex structure that, for example, conditional pass-through covered bonds have, because it's difficult to predict the final maturity date. It's a theoretical. I mean, it could be a 5-year, but 5-year plus 30 years. So in that case, this can represent a hurdle for some investors, especially bank-type investors. So the investor base for CPT covered bonds has been a little bit more reduced than the hard or soft bullet. Now, turning a little bit into the market, as I was saying earlier, the covered bond market started off mainly as a hard bullet format. And over the years, the soft bullet was introduced, and this has now become more and more the norm. Just looking at the ECBC statistics figures collected by Joost and his team, you see that compared to 2016, where the hard bullet format in terms of outstanding made up over 60% of the market. Now, fast forward a few years, you see it's inversed. Now it's mainly the soft bullet format that is predominant, whereas the CPT has always been a very niche product. And then looking in terms of jurisdictions, when you deep down, you see that there are differences in terms of jurisdictions, with some jurisdictions being mainly soft bullet format, some still predominantly hard bullet format like Luxembourg, and some mixed. So, for example, in France, you have both. And you have some issuers like CFF or CAFIL that still issue in hard bullet format. Now, I showed earlier slides up to 22, but looking at today, taking the data from the iBoxx Euro Covered Bond Index, you see that the share of soft bullet has increased and is now close to 85% of the market. And this is mainly due to the fact that the European Covered Bond Directive introduced the requirement to include objective triggers. And with the transposition of the directive into national laws, we had a further rise in the share of these soft bullet covered bonds, especially with the switch of the German Farmbriefe, where they switched from hard to soft bullets. So whereas before, prior to the covered bond directive, the German Farmbriefe were all hard bullets, now they've all turned to soft bullets. Now looking at in terms of issuance, because the slides before were outstanding, this is even more striking. So 2017, for instance, you had about a third of covered bonds issued in hard bullet format and 2/3 in the soft bullet format. Fast forward to today or up to yesterday, you had about 92 billion worth of covered bonds issued in soft bullet format, i.e. 95% of year to date, only 4% in hard bullet, and year to date we've had so far one issuer this year, Monte Paschi Siena, Italian issuer, issuing in CPT covered bond format. Now, you may ask yourself, now is there a pricing differential between the different structures? Now, there used to be a bit more one in the past between soft bullet and CPT, but today, actually, this pricing differential is almost non-existent. So starting off with pricing differential between hard and soft bullets, I've just mapped out two issuers which have different outstanding covered bonds, hard and soft. And you see, for example, in the French curve for the PPCE group, both PPCE, CFF, they're all aligned, so there's no differential, and the same for Santander. And in CPT covered bonds and soft bullets, on the left-hand chart, I showed out NIBC, for instance, the Dutch issuer. In the past, CPT covered bonds used to trade at a premium to soft bullet because of this narrower investor base I was talking about earlier. But recently, they're all pricing more or less along the same line, and the same with the Italian covered bonds. Now you don't really see much of a difference, and I have to say that when Monte Paschi Siena issued its CPT covered bond about a month ago, or it was in March, there was a huge demand for the transaction. They were to price at relatively tight level. Now, before I go, just here, you'll see a little bit of the history. Now, we've seen over the past few years, maybe over the past 5-6 years, a trend from CPT covered bonds back towards soft bullet. And this was mainly triggered by ECB. Basically, the ECB back in 2018, when it had the CBPP3 program as part of the QE, it announced that it was going to stop purchases of CPT covered bonds from issuers rated below junk. Then a few months later, the ECB announced that in terms of its ECB repo haircut scale, they were going to differentiation, and for own use covered bonds, the covered bonds with extendable maturity, they were going to use the legal final maturity, so then higher haircuts. Then in January 19, the ECB said that it was stopping purchasing CPT covered bonds altogether. It's part of its purchase program. And as a result, and given back in the day, ECB was such a big buyer of covered bonds, we had a number of Dutch issuers who issued in CPT format, which either created a new soft bullet program or launched consent solicitations to switch its CPT programs to soft bullet. And recently, I think it was just a week or two ago, we had the one Australian issuer that issues in CPT format who announced that it has set up a soft bullet program to coexist with its CPT covered bond program. And final slide, just for information, is just looking at the transposition of covered bond directive into national laws. And here you see, according to the different countries, what the different objective extension triggers are defined by law and the different liquidity buffer calculations. And with that, I will hand over to, calorimetric disclaimer, to Jane.